In the United States, inflation is often described as a silent force, an invisible pressure that slowly pushes prices higher over time. Groceries cost more, rent climbs, gas fluctuates, healthcare, education, and everyday essentials become more expensive year after year. For the average American, inflation feels like a constant uphill battle. Even when salaries increase, it rarely feels like enough. The paycheck comes in and disappears just as quickly. But here's the part that most people don't see. While inflation quietly erodes the purchasing power of the middle and lower class, it often works in favor of the wealthy. This is the inflation trap, and understanding it may completely change how you think about money. The illusion of progress. For many Americans, financial progress is measured by income growth. A raise at work, a better job, a higher salary. On paper, this looks like success. If your income goes from $60,000 to $75,000 a year, you've made progress. But inflation changes the equation. According to historical US data, average inflation has hovered around 2 to 3% annually over the long term, but in recent years, it has surged higher, reaching peaks above 8% during economic shocks. That means the cost of living can rise faster than wages for millions of workers. So while your income increases, your expenses increase too. Housing, which makes up a major portion of American spending, has seen dramatic growth in many cities. Rent prices in major metro areas have risen by double digits in short periods. Grocery bills have steadily increased. Healthcare costs continue to outpace wage growth. What feels like progress is often just maintenance. You're earning more, but you're not moving forward. The hidden erosion of cash inflation doesn't just raise prices. It reduces the value of money itself. If inflation is 5%, then $100 today will only have the purchasing power of $95 next year. Now imagine holding large amounts of cash in a bank account that earns little to no interest. Over time, that money is losing value without you even noticing. For many Americans, this is exactly what happens. Savings sit in low-interest accounts, slowly being eaten away by inflation. But the wealthy play a different game. They don't hold cash. They hold assets. Assets versus income. This is where the divide begins. Most people rely on income, money earned through work. The wealthy rely on assets, things that generate value or income over time. These assets include real estate, stocks and index funds, businesses, commodities and other investments. Here's the key difference. When inflation rises, the price of assets often rises too. For example, real estate values tend to increase over time, especially during inflationary periods. As the cost of building materials, labor, and land rises, property prices follow. Stock markets, despite short-term volatility, have historically trended upward over the long term. Companies raise prices to match inflation, which can increase revenues and, eventually, stock values. In simple terms, while inflation makes everyday life more expensive, it can also increase the value of assets. And the wealthy own most of those assets. The debt advantage. One of the most surprising ways the rich benefit from inflation is through debt. For most people, debt is a burden. Credit card balances, personal loans, and high-interest debt can be financially draining. But not all debt is the same. The wealthy often use low-interest, long-term debt to acquire assets, especially real estate. Here's how inflation works in their favor. Imagine someone takes out a 30-year fixed mortgage at a low interest rate. Over time, inflation reduces the real value of that debt. In other words, they are paying back the loan with cheaper dollars. At the same time, the value of the property they purchased is increasing. So while the debt becomes less significant, the asset becomes more valuable. It's a powerful financial dynamic. Inflation reduces what they owe, while increasing what they own. Wage earners versus asset owners. To understand the inflation trap, you have to see the difference between two groups, wage earners and asset owners. Wage earners depend on their jobs. Their income is often fixed or grows slowly. Raises may come once a year, if at all. But inflation doesn't wait. Prices can rise rapidly, creating a gap between income and expenses. On the other hand, asset owners benefit from growth that is not tied to their time. Rental income can increase with market rates. Stock portfolios can grow with the economy. Businesses can raise prices to match inflation. This creates a widening gap. Over time, asset owners pull further ahead, while wage earners struggle to keep up. While these policies can support the economy, they also tend to increase asset prices. Lower interest rates make borrowing cheaper. This encourages investment in real estate and stocks, driving prices higher. Who benefits the most from rising asset prices? Those who already own them. This creates a cycle where wealth continues to concentrate among those with assets. The psychological trap. The inflation trap is not just financial. It's psychological. Most people are focused on earning more money. It feels productive, logical, safe. But income alone cannot keep up with inflation in the long run. At the same time, investing can feel risky. Markets fluctuate. There's uncertainty. So people stay in their comfort zone. They work harder, chase raises, try to keep up, but they don't change the system they're operating in. And that's what keeps them stuck. Lifestyle inflation. There's another layer to this trap, one that is entirely within our control. As income increases, so does spending. This is known as lifestyle inflation. A higher salary leads to a better apartment, a nicer car, more dining out, and upgraded habits. These changes feel like rewards for hard work. But they come at a cost. If expenses rise as fast as income, there's little left to invest. And without investing, there's no ownership of assets. This means you remain dependent on your salary, while inflation continues to erode its value. Why the rich stay rich? When you combine all these factors, a clear pattern emerges. The wealthy don't rely on income alone. They own assets that grow with inflation. They use debt strategically. They benefit from economic policies. They invest consistently over time. Inflation. which is often seen as a problem, becomes an advantage. Meanwhile, those who rely solely on wages face a different reality. Their income struggles to keep pace. Their expenses rise continuously. Their savings lose value. Their opportunities to invest are limited. This is the inflation trap, and it explains why wealth inequality continues to grow. Breaking the cycle. The good news is that this system is not exclusive. You don't need to be wealthy to start thinking like an asset owner. The first step is awareness. Understanding that inflation is not just about rising prices, it's about the changing value of money. The second step is shifting your focus. Instead of only asking, how can I earn more? Start asking, how can I earn more? This could mean investing in index funds or stocks, saving to purchase income-generating assets, building skills that allow you to create additional income streams, reducing unnecessary expenses to increase your investment capacity. Even small steps can compound over time. The power of time. One of the greatest advantages the wealthy have is time. Investments grow through compounding. The earlier you start, the more powerful the effect. A consistent investment, even with modest amounts, can grow significantly over decades. But this requires patience and discipline, qualities that are often overshadowed by the desire for quick results. The inflation trap thrives on short-term thinking. Breaking free requires long-term vision. Final thought. Inflation is often described as a hidden tax, and for many Americans, that description feels accurate. It quietly reduces purchasing power, increases the cost of living, and makes financial progress feel harder than ever. But for those who understand how it works, inflation is not just a challenge, it's an opportunity. The difference lies in positioning. If you rely only on income, inflation works against you. If you own assets, inflation can work for you. This is why the rich keep getting richer. Not because they work harder, not because they earn more salaries, but because they play a different game. A game where money is not just earned, but multiplied. And once you understand that game, the trap becomes visible. And when it becomes visible, it can finally be escaped.